Let's start with something that might make you tilt your head. Ondas stock is up over 107% in the last 52 weeks. That's more than doubling in less than a year. Sounds like a huge win for anyone holding it, right? But here's the twist. At the very same time, over 41% of all the company's shares are currently sold short. That means a massive number of traders are betting this stock is going to fall. So we have a stock that's already doubled, and yet nearly half the float is positioned against it. Why would so many people bet against a winner? Stick around, because by the end of this video, you'll understand exactly why this stock is confusing even experienced investors right now. Let's start with the profit picture, because at first glance, it looks incredible. Over the last 12 months, Ondas reported $174 million in revenue and net income of $163 million. If you just look at that number, you'd think this is one of the most profitable small companies out there. In fact, the profit margin comes out to over 96%, which almost never happens in real business. But here's where things get interesting. When we look deeper into the income statement, operating income, meaning the profit the company makes purely from running its actual business, is negative $220 million. So how can a company lose over $200 million from operations, yet still report over $160 million in net profit? The answer is that the profit came from somewhere outside normal business operations, not from selling products or services. This is a classic case where the bottom line number looks great, but it doesn't tell you how the actual business is performing. And that's not even the most surprising part. Let's talk about cash. Because when a company loses money running its operations, you'd expect it to also be burning through cash. And that's exactly what's happening. Operating cash flow was negative $83 million, and after accounting for equipment and investment spending, free cash flow was negative $86 million. In simple terms, free cash flow tells you how much actual cash a company generates after paying for the basic costs of running and growing the business. A negative number means the company is spending more cash than it's bringing in from operations. So even though net income looked shiny, the real day-to-day cash engine of this business is still running at a loss. Now here's where investors often get confused, because you'd think a company burning cash would be running low on money. But that's not the case here at all. Ondas is sitting on $1.38 billion in cash, with only $6.41 million in total debt. That gives the company a net cash position of $1.38 billion, or about $2.42 in cash alone for every single share outstanding. The current ratio, which measures whether a company can cover its short-term bills with short-term assets, sits at 9.85. Anything above 2 is usually considered strong. 9.85 is exceptionally strong. So this is a company that is losing money from its core operations but has an enormous cash cushion protecting it. That combination alone creates two very different stories depending on which side you're looking at. However, one number changes the picture even more. Shares outstanding have increased by 297% in just 1 year. That means the company has been issuing a huge number of new shares, likely to raise money since operations aren't generating cash on their own. This is called dilution, and it matters because when new shares are created, each existing share represents a smaller slice of the company. It can also explain part of why huge cash reserves exist alongside a stock price that hasn't necessarily reflected that growth in share count. So the big cash pile isn't purely a sign of business success. It may also be fueled by continuously selling new shares to investors. Let's talk about returns for a second, because here's another contradiction. Return on equity, which measures how efficiently a company generates profit from shareholder money, is a solid 19.32%. That sounds encouraging. But return on invested capital, which measures how well the company generates returns from all the capital invested into the business, including debt and equity, is negative 16.07%. Two efficiency numbers, both technically measuring performance but pointing in completely opposite directions. This is exactly why looking at just one financial ratio can be misleading. Now here's where the story gets even more layered. The stock currently trades at a trailing price to earnings ratio of 47 and a price to sales ratio of 29.2. Both of these are considered high by traditional standards, meaning investors are paying a premium price relative to current revenue and earnings. Yet despite that already elevated valuation, the average analyst price target sits at $19.06, which is over 113% higher than the current price of $8.91. Analyst consensus is rated strong by, and revenue growth forecasts over the next 3 years sit at nearly 194%. That's an enormous expected leap in business size if it plays out. But remember that short interest we mentioned at the beginning? 41% of shares sold short, with a short ratio of 2.24 days to cover, meaning it would take about 2 days of average trading volume for all short sellers to buy back their shares. When a heavily shorted stock suddenly moves upward, short sellers can be forced to buy shares to limit their losses, which can push the price up even faster. This is often called a short squeeze. So you have big optimism from analysts, big skepticism from short sellers, and a business with strong cash reserves but weak core operating performance, all colliding in the same stock. One more data point worth mentioning before we wrap up. The Piotrowski F-score, which is a 9-point scale used to evaluate a company's overall financial strength based on profitability, leverage, and efficiency trends, currently sits at just 3. Lower scores generally suggest financial weakness, while higher scores suggest strength. A 3 is on the lower end of that scale, adding one more layer of caution to a stock surrounded by strong bullish sentiment. So where does that leave us? The real question is, as this company continues issuing shares and burning cash to fund growth, will that eventually convert into real operational profitability? Or will dilution keep quietly reshaping what each share is actually worth? That's something only time and future earnings reports will answer.